one of the things that you'll pick up, hopefully there'll be a few things you'll pick up tonight, the key is execution. It's not just about education. We want to build that education, but we actually want you to do stuff. Taking action is one of the most important things that you will need to do in your learning process, whether it's on superannuation, whether it's on property, whether it's on shares or whatever it might be, estate planning, etc. Any of the many topics and ranges of topics that we see in Money Magazine every month. Now, I generally like to walk around, but I can't do that today. I'm going to be confined behind this whatever you call this thing in front of me. So I will encourage you to ask questions. I always say there's never a silly question do I just forward this? Yes, I do. So feel free to butt in, raise your hand, whatever makes sense to you, because this is a learning experience, and I find if it's interactive, it'll be far more productive for you. I am very productive. I write for a few magazines and things like that, and I suppose the key to what I do is answer questions, and that is how that is how you move forward. I remember at school I never used to like to ask questions because I'd always feel embarrassed. Then when I went to university, well, I actually dropped out when I went to university, but I went back when I was 26 and studied accounting. And accounting for an 18-year-old at the time wasn't a particularly exciting experience. So I decided to nick off skiing in Colorado for a few years, and then decided to get a haircut and a real job and come back and work in the family business, and thought that a degree in accounting and a degree with tax might be a slight diversion from chasing around powder snow for a few years. So there you go. And in so saying, I actually started renovating houses when I was about 21. I bought my first house. Literally tore the guts out of it, renovated it, painted it, tiled, kitchen, the whole kit. And since then I've done about 15 or 20, and I haven't done one for a few years now, but I went to get financial advice, and I was actually horrified with the sort of advice that I got. It was really sell down your property, buy a managed fund from me, and this is from about 5 different advisors. And I did become a little bit cynical about the industry, but by the same token I actually thought that was an opportunity to go out there and provide fee-for-service style advice to people that genuinely are in need of good tax advice, good strategy advice, and good product investment advice, whether it's in shares or property. But it's not related to how much I earn, and not related to how much the company that might own me or is related to me might earn. So therefore, I am independently licensed. I hold our own financial services license, and we deal in self-managed super funds, non-self-managed super, so normal superannuation funds as well, which many of you will have today. So today I'm talking about SMSFs. What are they? How do they work? Some of the strategies that you might be able to utilise to boost your superannuation inside an SMSF that you might not be able to do outside an SMSF. But first of all, who's got one? A few? Yeah, good. Who's thinking about one? A few more. Okay. Let me just go through these slides for you to give you a bit of a more in-depth overview of self-managed super funds. We all have to put up this wretched advisor warning. Generally, what we talk about today is all general in nature. We need to understand your needs, goals and objectives before providing specific advice. So I'll skip through that quickly. I'll skip through the books and what I've done. That's all very boring. Again, I'll reiterate the fact that there's never a silly question when it comes to your own money. And the reason why I said that is because during the GFC, a lot more people should have been asking questions about their investments that didn't. There's an ASIC website called moneysmart.gov.au. I know Money Mag talks about it on a regular basis, but if you invest money in this country, you should have gone to that website and looked at some of the companies that have been banned, some of the warnings that are out there, and be aware of some of the scams that people are utilising to defraud you of your hard-earned dollars. Now, just to reiterate, when it comes to financial advising, and I suppose it depends on the type of advice you're looking for, but the type of clients that we're dealing with generally want comprehensive financial advice, and that focus should be primarily on your needs, goals and objectives. But to do that, we need to understand your entire situation. We can't give you advice under Regulatory Guideline 175 unless we completely understand your situation. So we need to understand your needs, goals and objectives, your dates of birth and all those sorts of things. And financial advisors will send out a questionnaire if you haven't seen one already. How many of you have an advisor? Quite a few. Anyone thinking about using an advisor? A couple more? Yeah? No? You look very strong in that thought. They suck. Security to aisle 4, please. Thank you. Good to have your support, sir. Thank you. Love you back. Thank you very much. Woo, tough crowd tonight. Thanks, F, you didn't warn me on that one. So a good financial advisor should be looking at your cash flow, your net wealth, your shares in your funds, your property, superannuation and retirement planning, of course, your debt management, risk and insurance, whether you need insurance or not, tax planning, of course. I think you should be seeing someone with a tax degree. I think that's pretty important when they're giving financial advice. And, of course, estate planning. So a good advisor will bring all these things together, focus on your needs, goals and objectives, and then give you a bunch of recommendations to hopefully put you in a much better position than you were before you entered their office. Now, what is superannuation? I think there's a lot of confusion around super. Superannuation changes every year, doesn't it? Every budget, there's a whole bunch of announcements. Some of those become law and some of them don't. This is a confusing part. So what happens over time is that consumers like yourselves are unsure as to what is actually law and what's not, and what David, the local barbecue, said is actually true, or whether it's not about capital gains tax. Hey mate, you can live in your house for 12 months and then go and rent it for 12 years and it'll be free of capital gains tax. You know, who's heard those sorts of stories? Superannuation, by its definition, is a concessionally taxed savings structure designed to fund your retirement. It's not a product that you buy from somebody. Okay, it used to look like that. Back in the day, Simon could attest, you know, any of the major financial institutions would sell you a superannuation fund. They'd usually make between 4 and 8% commission on that. It's good business back in the day, probably not so crash hot now in terms of commissions, but that's a good thing for you guys. It's a structure under which you invest. Now, we did a story on Your Money, Your Call quite some time ago on how much you're going to need. Has anyone ever read 7 Habits of Highly Effective People? Yeah? Begin with the end in mind. This is what you need to do with superannuation. Begin with the end in mind. Understand how much you're actually going to need to fund your retirement. And then you can work out how you're going to invest, what your risk profile is, what asset classes you might want to invest into, and whether a self-managed super fund might help you get to your point of completion, so to speak, or the point where you actually want to retire. And Simon made a good point before that you can retire any time you like. You just can't access your super until, if you're born after 1965, until you're 60 years of age. And today, if you retire, you can't touch your super until you're 56. So that's preservation age, but you can invest outside of super, and that's okay as well. So often we'll recommend to clients to invest some money outside of super, and a significant amount as they approach retirement age. The problem is the changes, isn't it? How many of you get confused by super? A lot. Hopefully you read Money Mag and that helps you understand a little bit better. But it is a very confusing topic. So we don't know, even I don't know, Simon and none of us know and understand what the changes to superannuation are going to be in the future. There are no guarantees. And particularly with a government that's running a $50 billion deficit. You know, Malcolm Turnbull was talking today about not actually having a surplus in the near future. We need to start getting used to that sort of stuff. And they are going to target retirees to increase taxes, because at some point in time they're going to have to increase taxes to reduce that debt. So how much are you going to need? Well, you know, you often hear that you need $1 million to retire with 60 grand a year. I actually reckon that's true. You might need $800,000 and a part pension. That would also get you to a similar sort of level. But you want to be self-funded. Why? Because if you look at the CPI figures every year, the things that are going up are the essentials: healthcare, utilities. The things that are going down are the flat screen TVs coming in from China. How handy are they going to be when you're 86 years of age on an age pension at $23,000 a year? My ex-wife used to spend that on shoes. I don't know how you can live on that. You know, it's a very, very modest living. Possibly the generation that went through the Great Depression would be used to living on those sorts of incomes. But if you're working today and living in Sydney, if you're young and paying rent, there's no way you can live on that. That's what your rent is going to be. That's why so many of you are staying at home until you're 45 years of age, until you can afford a deposit for your first home, let alone pump money into superannuation and pay for the kids' private school fees and the BMW you've got to drive to keep up with the Joneses. It's tough out there living in Sydney, isn't it? We have high standards. We have a high standard of living, but we have a $2 trillion sitting in superannuation, but we need $3 trillion. We have a huge retirement savings gap. So, as Simon and Kathy were talking about, we can use a number of strategies to boost your superannuation. Transition to retirement, salary sacrifice and co-contribution. And I hope some of you are just shy in saying you're not using salary sacrifice by raising your hand when Kathy asked the question. Because salary sacrifice should be a no-brainer. If you're 56 to 65 or 64 and still working, you should have a transition to retirement almost 99% of the time. Unless you're a surgeon earning $2 million a year and you're both pumping as a partner 180 grand into super and $35,000 concessional contributions each, you should be using a transition to retirement pension. Now, these are the basics. These are the dotting the I's and crossing the T's that a good financial advisor should be doing for you. Send a link. Go and see a physio. If you're over age pension age, and I don't think there's anyone here that looks like they're over age pension age today, but Centrelink do run free seminars. They're well worth having a look at. Have a look at their website. Ring the physio, Financial Information Service Officer, 132300, I think is the number. Those guys are there to help, and they are fairly proactive. Self-managed super funds, the fastest growing sector of superannuation at the moment. There's about 1.1 million people with a self-managed super fund in Australia, and about 540,000 funds in this country. Now, most people are setting these up for two major reasons, and it's not investment returns. It's flexibility and control. They're looking to be the masters of their own domain, not necessarily looking for the best return, the greatest fund, the cheapest insurance. They want to do things themselves and take control. And this is why during the GFC, the number of self-managed super funds went through the roof, because everyone turned around to the industry, retail and corporate funds and said, bugger you, if I'm going to lose money, I'll do it myself. Have any of you thought that way when setting up your self-managed super fund? These days, there's a lot more things we can now do inside self-managed super funds to boost your super. And again, as Kathy said, it's all about reducing your tax and boosting your retirement savings, whether it's inside or outside of super. You can have term deposits, you can have bonds, and during the GFC, that was great. Your average self-managed super fund has $1 million. Stick that into a term deposit at 7%, live on 70 grand a year, you're home and hosed. Woohoo! You're retired, baby. And then what happened? It's bloody interest rates. From 7% down to 2.5%, 2.25%, heading to 2%, heading to 1.5% according to David Bassanese. He's always a bit of a bear, but he's probably not far wrong at the moment. You can't live on $1 million sitting in 2.5 or 3%. With your ING, I think they've got a special at the moment at 3.5, 3.25. That's about the best you're going to get. That's $32,500 a year at 3.25%. The self-managed superannuant has had a pay cut of over 50%. They need to start investing elsewhere, and this is one of the frustrations. And now you can gear inside super. What have we seen happen to the property market in Sydney in the last 18 months? It's gone up 40%. Now, I'm not a property spruiker, and I suggest that you avoid those people at the greatest expense. They will cost you a lot of money. What happened to the property market 5 years prior to that? Nothing. Absolutely nothing. Now, shares and property go up and down like this. Sometimes they go up, sometimes they go down, and that's the nature of investing. Over time, yes, they probably go up by average around about 7 to 8% over a 10 or 20 year period, but it is cyclical. That's a fact. But you can now gear using tax effective money to repay that debt very quickly inside a self-managed super fund. That's one of the things I'll be talking about tonight. Now, we've talked about the amounts in self-managed super. There's about 2 trillion in super, and about 35% of that is in self-managed super funds. Interestingly enough, by number, SMSFs only make up about 3 to 4% of the population, but they make up about 35% of the amount of money in superannuation. You may conclude that those people are better educated, earning more money, putting that into superannuation, and making the decision to take control of their own situation. But it's all about control and flexibility. I guarantee you will not get necessarily better returns from super just by having an SMSF. That cannot be said. If you're looking for information on self-managed super funds, the ATO now have a series of videos. So go to ato.gov.au, type in SMSF, or you can search under SMSFs, and you can watch those videos. They're highly educational, and they'll give you a good understanding of how it all works. How do you set up an SMSF? Well, it's fairly simple. As far as cost, you're probably looking at somewhere around about $500 to $800 to say $1,000. Ongoing administration somewhere around about $2 to $3 grand a year, plus an audit of somewhere between sort of $300 and $600 a year. So that sort of gives you a bit of an idea on cost. It depends how much you have inside your superannuation as to whether it's worth setting one up. The ATO suggested a benchmark of around about $200,000. Now remember, with an SMSF, by its definition, it's a privately owned super fund with a maximum of 4 members or less. Okay, so you can actually pool your funds to invest. This is one of the major advantages. So you've got Mr. and Mrs. Mrs. has 80 grand, Mr. has 150 grand, put it together, there you have 230 grand to invest. Okay, you can then use that to invest in your other assets. Now there's lots of rules and regulations around it, which is why I recommended you have a look at the ATO website, because they will talk about, in their videos, they will talk about all those rules and regulations and how they affect you. Relatively easy to set up. These days you've got the option of a corporate trustee or individual trustees. We would generally recommend a corporate trustee. It's more expensive to set up, but for some reasons, such as the new fine regime they've introduced, you're probably better off having a corporate trustee for a self-managed super fund. You're very quiet. It's concerning me. 8 o'clock, is it dinner time? Do you miss out on dinner? Do you need to be home? Okay, no phones have called, which is great. I'm going to give away a free copy of my book to anyone that asks a question. So there you go, there's some incentive. So it's just like your money, your call on a Thursday night, just to get the phones ringing when the footy's on. But I know superannuation is such an exciting topic. We're just such a joy to be at dinners, aren't we? Tell you what. Hopefully I'll click over more than one friend on Facebook soon. Now, rolling over and paying your super into an SMSF is fairly simple. Your current superannuation funds will provide you with a rollover statement, an ETP form, so to speak, and that'll give you all the details to give to your accountant or administrator. You generally do need a team of people to assist you, and at least an administrator or an accountant. Unless you're already an accountant, you will need someone to do the tax returns, the member statements, and all the administration that might go along with running a self-managed super fund. Okay? And that is what you'll pay for. So that's the 2 to 3 grand a year. Someone to do those sorts of things for you. You may choose, if you so desire, to use a financial advisor for one of two things. A, strategic advice. How do I set up a pension? How much should I salary sacrifice? How do I set up transition to retirement? How do I avoid or reduce the amount of capital gains tax I'm going to pay on the property I'm about to sell and pump the money into superannuation? What's the maximum amount I can do? There's some great things such as a reserving strategy in a self-managed super fund that you can utilise where, let's say you are selling a property or an asset or possibly even a business where you've got a large capital gain. You can put up to 70 grand individually into a super fund and use a reserving strategy where you can reduce your taxable income by that 70 grand, assuming you're over the age of 50, 35 grand goes in this year, 35 grand goes in next year. But you get a tax deduction in the current year for the full contribution. A couple can do that, thereby reducing their taxable income by 140 grand a year, thereby either eliminating or reducing capital gains tax. How do I know this sort of stuff? Because when I was a young bloke renovating houses, I got slugged with a $100,000 capital gains tax bill, and I thought, how the bloody hell can I avoid that? I really shouldn't have dropped out of uni when I was 19 years of age at La Trobe. We need to understand these sorts of things when we're managing our own assets. So how to run a compliant fund? Well, this is the exciting stuff, and I'm not going to go into a lot of detail about this because I don't want to put you to sleep. I'm the last speaker tonight, so the idea is to try to make things more interesting by keeping details to a minimum with respect to the compliance. But there is a thing called the sole purpose test. The sole purpose of superannuation, as we discovered today in the announcements, is for retirement planning purposes. If you get a personal benefit from your fund before you reach a condition of release, you may have an early access to super problem. So you're not allowed to access your superannuation until you reach a condition of release. Okay? That's really important. Now there's in-house asset rules and things like that where if you're going to set up a self-managed super fund, buy a rental property and then put your daughter in it who's going to University of New South Wales and the property's just around the corner, that is also illegal. And you can be fined, you can be disqualified as a trustee, you can lose half the fund's assets. There's some very serious penalties that can come your way if you don't play the game according to the rules of the ATO. And it is very difficult to get away with these sorts of things. These days they've introduced a new, what they call a speeding fine regime. So there's a penalty unit that is applied to whatever it is that you've done, whatever naughtiness you've engaged upon throughout the financial year. It's $180. So they'll start off at 5 units, $180, $180 per unit, $900 for 5 units, up to $10,800 for a single fine. So I've had a question in the Financial Review, which I wrote an article for yesterday, which is answered on Saturday, for someone who accessed their superannuation fund because they were suffering from some financial hardship. And they didn't talk to Centrelink, they didn't do anything, they just took the money out. You can't do that. You may be subject to an instant $10,800 fine for doing something like that. So if you're looking at setting up a self-managed super fund, getting the right advice from a good accountant or advisor, ideally a specialist, FPA and also what was SPA, now the SMSFA, and the FPA and the Self-Managed Super Funds Association work fairly close together, so I'm sure they won't mind if I promote both of them. But you should be using a specialist on these things because your average accountant only looks after about 5 funds. A specialist will look after probably greater than 50 funds. I think we look after 200 and something funds. So that's pretty much all we do in terms of our accounting business. So the administration is really important, making sure, and again, a good administrator will do all that for you. So you don't necessarily have to worry about it, but you need to be aware that the burden of compliance falls on you. Okay? You're still quiet. They usually like this.
They're very attentive and listening.
They are, aren't they? You're used to that. What the hell is this diagram? This is how you borrow money inside a self-managed super fund. It is rather complex, isn't it? This is the thing, you've got spruikers out there at the moment in the real estate sector. There's a story in the AFR today I noticed online about one such person who's been banned for giving so-called advice on how to utilise property inside a self-managed super fund. I reckon it's a great strategy. I really do, and I can honestly hand on heart say that. I've been investing in property since I was a young guy. Our core business is not property. Our core business is actually managing assets, generally through term deposits, shares and bonds. But I do like property, and I think diversity is the key. And if you're 5 years away or more from retirement and you're earning over $150,000 and your income requirements in terms of your expenses are less than 80, then there should be some upside to gearing, whether it be inside or outside of your fund. Okay? I'm not suggesting you jump into the southeast Queensland property market at the moment. You know, we've seen no movement in that for 10 years now. I've still got clients that we're reversing out those investments over the last 10 years. Not that we put our clients in there, but they were stuck in it from other people, other seminars they go to. Remember they used to fly people up there? You get free flights and accommodation, you probably get dancing girls on the other side. And you get sold this crappy property that was actually valued at less than what your loan was. And here you are 10 years later, still holding the loan, still holding the property. You've got vacancy rates all over the place, cracks in the slab, and all these other sorts of problems. Don't do that inside a self-managed super fund, okay? Do your research. Ideally use an advisor. Use a buyer's agent if you need to. I think that's actually a really good thing, a fixed price buyer's agent to go and find you a property. But if you're going to look for a 2-bedroom apartment in Newtown, Randwick, Leichhardt, Neutral Bay, over the long term, you'll probably do all right out of those sorts of investments. If you're buying something off the plan in an area that's got 35 different buildings going up around it, you may find that we could experience another 2007 event in property, 2003 tech wreck, 1997 Asian crisis, 1987 share market crash. We're going to get another black swan event at some point in time. But in the properties that I've invested into, second-hand properties, investing inside a super fund can make sense as long as you've got diversity and liquidity. The beauty is, as Kathy was saying, is that you can use tax-effective money to repay that debt. So rather than, and in fact, Simon had a great slide up there that showed you the different tax rates you pay under different entities. So in your own name, you pay up to 49% at the moment. You throw in all the different levies and other Christmas presents we got last year. In super, you can put money into super and pay only 15%. You can save over 67% in tax. And you can then use that tax-effective money to repay the debt. You've got two members of a couple doing that, paying off debt of $70,000 a year, and the bank will only lend you 70 to 80% on these things anyway. You're going to pay it off pretty quickly because it's going to be cash flow positive, using tax-effective money to repay it. And ideally, you're buying in a good place with strata fees that aren't out of control, and you've done your research on the sort of property. I don't sell property, so I won't be selling one to you. But this is a good way to do it. Does that make sense? I'll talk quiet if you'd like me to. This chart basically shows how over time, using the concept of return on investment, so not only compound interest, but the beauty of being able to borrow money conservatively. Let's not go and borrow 110% and end up in a storm financial scenario where you're already retired, you have no income and you're borrowing against your house. That stuff's crazy. But where we're borrowing modest amounts against good quality assets and then repaying that money with tax-effective superannuation contributions. Does that make sense? Okay, yes, question. Oh, thank God.
Limited recourse borrowing, have that word.
Yes. Inside superannuation, you can only borrow money under a limited recourse borrowing arrangement. That means that you can only, the bank will only lend against the assets inside the fund that you're specifically purchasing, so for that actual property. So if you go bust or your fund can't afford to repay the loan, they only have access to that asset. That's it. In theory, that is correct. In practice, the sneaky banks will get you to sign, most likely, or try to get you to sign a personal guarantee, okay, which then encompasses the rest of the assets. Some banks don't do that, so again, you need to shop around. So I've just done one personally through CBA. They have asked for a personal guarantee, which I agreed to because their interest rate was highly attractive, their loan-to-value ratio was 80%, and they would lend against a rural property. So for me, I was actually buying a farm, so you can use the farm, you can use up to 5 hectares of that farm personally if it's for primary production purposes. So that's great. Spent the weekend down in Barrel using my superannuation money. So you can do things like that that you can't do inside an industry fund. Okay? Got yourself a free one. Yes, sir? The question was, is your superannuation money counted in your assets test? It's a good question. So if you're over the age of 56 and you're in pension mode, then yes, your assets will actually be counted under the assets test. However, if you or your partner is in accumulation mode, so you're not drawing down on your super, it's not counted under the assets test until you attain pension age. Okay? So if you're in this situation, you're actually allowed to cash money out of your super fund if you've reached a condition of release. So you can still get access to the money if you need the income. But for the assets test, we can boost the amount of age pension you get by leaving a large portion of your funds in accumulation mode until you attain pension age. It's a very common settling strategy we do with clients. Either that, or sometimes we have a client where, let's say Mr. is 65, so he's attained pension age, all his assets are going to be counted. We cash it out of his name, put up to $540,000 into her name, thereby reducing his assets test and boosting the amount of age pension he's going to get, and putting the money, or essentially hiding the money, in her name. And it's a perfectly legitimate strategy for those people accessing the age pension. Well recognised by Centrelink. What happened when the US... I'll talk a little bit about how we invest. So a self-managed super fund also needs a written investment strategy. You need to make sure that your trust deed is up to date if you've already got one. If you're over 56, make sure it includes transition to retirement, because if you're drawing a transition to retirement and it's not included in the trust deed, you could be being a little bit naughty there and therefore not truly having access to your superannuation. Putting together an investment strategy. So you've cashed your money out of super, you've closed down your industry, retail or corporate fund, you've set up your self-managed super fund, and you are now the master of your own domain. And you're sitting there wondering, what the hell do I do now? You thought you could do it, you thought it was going to be easy. Now you've got this 2, 3, 4, 500 or $1 million sitting there in cash, wondering what you're going to do with it. You then need to invest it. And right now, that's a little bit tricky, isn't it? We are range trading between 49.30 and about 5300. We were range trading between 5,000 and almost 6,000, and then we've started to hit certain ceilings and bottoms, and it's very frustrating. What happened to the Dow Jones when interest rates went to zero? It went up 120%. It's now off about 10 to 15%, and frankly, I think there could be further to fall for the US. We're currently in earnings season, so it should be very, very interesting. But when you're investing, whether you've got an industry fund, a corporate fund, or a retail fund, you need to understand the relationship between risk and return. The higher the risk, the higher the return. If you're young, you've got 20 years before, 30 years or 40 years before you can access your super, there's no point in having it in a conservative fund. Nor is there much point in paying high fees. So it probably wouldn't be worth setting up a self-managed super fund if you've got 50 grand sitting in super and you're paying $3,000 a year in fees to an accountant to administer the fund. You're probably better off in a new My Super account, which will have 0.5% or 0.8% in fees and cheaper insurance for you and better options in terms of how you invest at a cheaper rate. Flexibility, volatility, liquidity. 3 things people didn't consider during the GFC. How easily can you get access to your money? Did any of you have frozen funds during the GFC? Yeah, one. How did that make you feel?
Not good.
Really bad, doesn't it? Yeah. It's your money, but you couldn't get access to it. There's nothing more frustrating. So liquidity is really important. You don't need liquidity if you're 20 years of age and you can't access your super till 60. Timing of markets is important, but I can promise you there is not a software program, and stop buying them, that will tell you when the market bottoms and when it tops. Okay? It doesn't exist. If it did, we'd all use it. Warren Buffett's not bad, but he's not that good. He's pretty good. Cost is important. You don't want to pay too much for anything, and tax is absolutely paramount. This is what blows me away with the financial planning industry is you do not need a tax degree to give essentially tax advice. Ridiculous. The Income Tax Assessment Act was written in 1936. They tried to rewrite it in 1997. And then we overlay that with the Superannuation Industry Supervision Act, which adds extra complexities to it. And you'll understand that every budget, they make other and new announcements that confuse the situation a little bit more. It's very confusing. You do need a tax degree to give strategic advice, in my opinion. Now, I'm probably running out of time, so I won't go into a lot of detail around how we invest, but think about these things when you're investing. The global economic themes. What are the themes right now? Anyone want to give me a few tips? US interest rates? The Fed, exactly. So Janet Yellen said at some point in the not too distant future, you can expect interest rates to rise and rise relatively quickly once it starts. And she didn't actually raise rates, but what happened to share markets, global growth and confidence? We literally lost 50 billion overnight. We didn't even need to raise rates. It was the potential, excuse me, the potential of raising rates, or the thought that they were going to go up. They should have just raised them. But that's one of the themes at the moment. A slowing China, 6.9% GDP growth. They're consuming less of our materials. Australia is 50% reliant. 50% of our income comes from iron ore. Okay? What's happened to the iron ore price? Bang. It's got nothing to do with Rudd, Turnbull or Abbott, but it's majorly affecting how much money they've got in their pocket to fund our roads, because half of our income in Australia comes from iron ore sales overseas. So think about these global economic themes. It's not likely to improve in terms of the materials cycle in the near term, although some people have been brave enough to call the bottom of the materials cycle. Asset allocation, how you invest. What sectors do you like? What sectors have you got? What options have you got? How many of you have an industry fund? Cool. Industry funds have seen the flow of money out to self-managed super funds, and they've made some changes. And I must say it's for the better. You can now trade shares, if you're slightly cynical like the gentleman at the back there, of financial planners like myself, you can now do it yourself, can't you? But you're probably doing that, are you?
In theory, you can do that.
Yeah, you can. So you can buy and sell shares, probably ASX 200, you can even buy and sell exchange traded funds to give you better access to things like the international markets. And they've been some of the best performing markets in the past few years for two reasons. A, what's the other theme? Aussie dollar. What's happened to the dollar? $1.10 down to 70, 72, 73. It's actually bounced back a little bit more recently. But with interest rates looking like they're going to go down again, a lot of pundits are suggesting that might happen as early as in 2 weeks' time. That's certainly looking pretty good right now. So these are the global themes that are occurring, and this is how you have to think when you're investing money. When interest rates go down, what happens to property prices? They go up. They've already gone up 40%. They're going to go up another 40%? No chance. It's not going to happen. I'll guarantee it's not going to happen. They cannot go up another 40%. Why? Mortgages have also gone up 20%. They've increased. Wages growth has not gone up 40%. Wages growth only goes up by about 4.5%. So we can't keep up with that level of growth. But nothing happened for 5 years, so I'm okay with the fact that property prices have gone up. They'll probably come off the boil for a while, and then they'll modestly continue to increase over time. Sector analysis. What sort of sectors work at the moment? What sort of sectors are a good place to invest right now? Banking? You? Aged care? Aged care's done it. Healthcare? Good answer, Simon. I think he's done this before.
Just trying to help out.
No, I appreciate it. Thank you. It's quiet. It's a tough crowd. Thanks. Ramsay Healthcare, CSL. These sorts of companies have done very well over the years. They've also got consistent earnings growth. So if you're investing into shares, look for companies that have consistent earnings growth and economic resilience. Good management is important. Consistent growth in troublesome economic times. Woolworths used to be one of those stocks. Is Woolworths a good investment today? What do you guys reckon? You're not sure, are you? No. I've sold out of Woolworths. I wouldn't buy Woolworths for this one reason. I started shopping at Aldi. You know how they brought out those new ads and they've got that really cynical person? That was me. And I went into an Aldi and I realised they've actually got good fresh food. The chicken fillets are really cheap. And the honey's half price. I thought, what's that going to mean for Woolworths? Now, I'm sure Woolworths have the cards, and my 4-year-old and my 8-year-old begged me to go to Woolworths so they can fill their little booklet with cards, which I have actually done in the last few weeks. But as soon as those booklets are full, I'm back to Aldi. So this is one of the themes we need to consider. There's also a threat that another European company will come into that sector. So these are the sorts of things we need to apply, and you don't need to be a share analyst to work this stuff out. What's happened to Metcash, who supplies to IGA supermarkets? MTS is the investment code, so I won't test you too much on this. But the share's gone from $4.50, which was already fairly low, down to $1. It's since risen a little bit. $1.50 at the moment, it is correct. It's been absolutely hammered for the same reason, massive levels of competition. So think about what's happening in the sort of sectors that you're looking at investing. If you invest into an industry fund, they're going to make those decisions for you. And I'm not anti-industry fund. In fact, I'm pro-industry fund. I think for the right people, they're absolutely sensational. It's a low cost, good return, well run, also low cost insurance, which is fantastic. And often with self-managed super funds, we get a little bit cheeky. We might leave $5,000 in the industry fund, still keep contributing to it, roll the funds out to a self-managed super fund, and utilise that to reduce capital gains tax, go out and buy property or invest into shares and cash and bonds and other assets, and we therefore diversify. It's horses for courses. There is not a one-size-fits-all. So I'm not here to sell you self-managed super funds. I like industry super funds. Effie, I think, holds her money in an industry fund. Is that right?
Yeah, I do.
Aussie Super. I asked her that the other night on the show. Which surprised me a little bit, I must say. But that's very cool.
Doing your trading as well. It's not in theory. You can.
Do you use a share trading?
Yes.
There you go. Good stuff.
I was
ethical super funds. Yeah, this is really good. I actually manage my clients' money through a managed account. And in setting those managed accounts up as we did years ago, first of all, they don't pay trail commissions and all that sort of stuff, but we set up a conservative, balanced, growth and a tailored fund. You can do whatever you like. We then set up an ethical fund. We thought this is going to be the best thing since sliced bread. I finally feel like we can do something for people that want to have a view to sustainable living, to reducing pollution, and reducing use of paper and low energy costs and things like that. So I thought that the take up on this was going to be huge. No one put any money into it. And then finally, after 3 years, one client decided to put 300 grand into it. And we had to shut it down because not only was no one using it, but there was no research available for us to help us make decisions about investing. And I actually got asked about that very same question today. I think they're fantastic, and I'd love more people to be using ethical, either super funds or managed funds or whatever. The trick is, in Australia, I don't think we have the investment. I don't think there's enough investments in Australia, given the fact that we're resource heavy and financials heavy, to support the ethical investment market. There's a lot of great small companies that you might want to invest into, but they're not necessarily investment grade. You've got other risks, company risk, market risk, industry risk, other things that come into play. I think they're great, but maybe start off with a small portion of your investments and just be cautious of how you invest that. Internationally, probably much better, because you get more diversity, more choice.
So I got an email the other day about Australian Ethical Super, and they were saying that they were outperforming some of the other funds at
Yep.
the moment.
Yep. Was that from Australian Ethical Investments, the company? So I know they've been around for a long time. I can't endorse a company, obviously, because I don't know and understand it. But like anything, you need to undertake your own due diligence on these sorts of things. But ethical investing, I think, is great in theory, but when it comes to convincing people to put their real hard-earned dollars into an investment, they actually want to make sure the integrity of the investment is going to stand up in all conditions. So that's the only point I would make in that respect. We then talk about, in terms of self-managed super funds, stock analysis and then stock selection. So putting together a watch list of shares, and I must say half of my clients are in a conservative fund. Our average client's over the age of 50, they invest about $1 million with us, they're conservative, so we have a large amount in cash and bonds still. So we're only investing probably around about 40 to 50% of our total client funds in Aussie shares, in fact in shares, and of that probably about 30 to 40% is in Aussie shares, the rest is in international. We've increased our international significantly in the last 3 years. During the GFC, we had zero international. We had massive levels of cash because you didn't need to take risk to get a good return back then. Now you actually do. And as you approach retirement, this is one of the frustrations, isn't it? You need to probably be a little bit more aggressive in how you invest. So I've said there about 60% of our clients are conservative, and that's fairly typical of self-managed super funds. Once you have money, thank you, I'm getting the wind up. Once you have money, you want to protect it. And that's the key. So as I've said, there's never a silly question when it comes to your own money. If you have a question on transition to retirement, salary sacrifice, self-managed super funds, don't ring your super fund. If you have a question on self-managed super funds, ring your accountant. But ring your superannuation fund if you have a question. Talk to an advisor. Read Money Magazine. It's a great, near free experience. You know, for what is it, $10 a month? $7 a month, there you go, what a bargain. You know, it's a great source of free information and education. So the key, I reckon, is all about education, and that's what tonight's all about. So thanks very much for joining us. Hopefully you've learned something you didn't know before.